What if I told you that a professional dancer with no formal financial education managed to make over $2 million in the stock market? Sounds unbelievable, right? But that's exactly what happened to Nicholas Darvas, the author of the famous book, How I Made $2,000 in the Stock Market. This book is not just another investing guide. It is a real-life story of failure, learning, discipline, and extraordinary success. Nicholas Darvas, how he transformed himself from a complete beginner into a millionaire investor using a simple but powerful strategy. In this video, we'll explore the key lessons from the book, understand the famous Darvas box theory, and learn why this book remains relevant even today. So, sit back, relax, and let's dive into one of the most influential investing books ever written. Who was Nicholas Darvas? Nicholas Darvas was born in Hungary and later became a successful professional dancer. He traveled around the world performing with his dance partner and had little interest in finance or investing. One day, instead of receiving cash for a performance, he was paid with shares of a company. At first, he knew almost nothing about stocks, but when the value of those shares increased, he became curious about the stock market. Like many beginners, Darvas believed making money in stocks would be easy. Unfortunately, reality proved otherwise. He listened to tips from brokers. He followed rumors. He bought stocks based on recommendations from friends. And as a result, he lost a significant amount of money. But instead of giving up, Darvas decided to study the market seriously. He analyzed his mistakes and developed a system that would eventually make him millions. The early failures. One of the most valuable aspects of this book is that Darvas openly discusses his failures. Many investing books focus only on success. Darvas does the opposite. He explains how he repeatedly lost money because he relied on other people's opinions. Every time someone told him a stock was about to rise, he bought it. Every time a broker recommended a company, he invested. Most of these decisions ended badly. Eventually, he realized that successful investing requires independent thinking. He understood that blindly following tips was a recipe for disaster. This lesson alone is worth remembering. Never invest simply because someone else says a stock is good. Always do your own research. Discovering the Darvas box theory. After years of observation, Darvas noticed an interesting pattern. Many successful stocks moved within a specific price range for a period of time. They would trade between a support level and a resistance level. Then suddenly, they would break above that range and continue climbing higher. Darvas called this range a box. This observation led to the creation of the famous Darvas box theory. The strategy was simple. First, identify a stock that is moving within a price range. Second, wait patiently. Third, buy only when the stock breaks above the upper boundary of the box. If the stock falls back below a predetermined level, sell immediately. This approach allowed him to enter strong trends while limiting losses. The beauty of the system was its simplicity. He wasn't trying to predict the future. He was simply reacting to what the market was already doing. The importance of trend following. One of the biggest lessons from the book is the importance of following trends. Darvas believed that the market itself provides clues about where money is flowing. Instead of looking for cheap stocks, he searched for strong stocks making new highs. This idea may seem strange to many investors. Most people assume they should buy stocks after prices have fallen. Darvas believed the opposite. He preferred buying stocks that were already rising. Why? Because strength often attracts more buyers. A stock making new highs may continue moving higher as more investors notice it. His philosophy was simple: the trend is your friend. The power of stop losses. Another key principle in Darvas's strategy was risk management. He always used stop loss orders. Before entering a trade, he knew exactly how much he was willing to lose. If the stock moved against him, he exited immediately. No excuses, no emotional decisions, no hope that the stock would recover. This discipline protected his capital and allowed him to stay in the game. Many investors lose money because they refuse to accept small losses. They hold losing positions and watch them become bigger problems. Darvas understood that small losses are normal. Large losses are dangerous. His goal was not to avoid losses entirely. His goal was to keep losses small and manageable. Controlling emotions. The stock market is driven by emotions. Fear and greed influence millions of investors every day. Darvis recognized this reality. He understood that emotional decisions often lead to poor results. When a stock rose rapidly, many investors became greedy. When prices fell, panic spread everywhere. Darvis tried to remove emotions from his decision-making process. He relied on rules instead of feelings. He trusted his system rather than his emotions. This mindset helped him remain calm during both good times and bad times. Why Darvis ignored market noise. One fascinating part of the book is how Darvis often invested while traveling around the world. Because he was constantly moving between countries, he couldn't spend all day watching financial news. Ironically, this became an advantage. He wasn't distracted by daily headlines. He wasn't influenced by endless opinions. He focused on price action and market behavior. Today, investors face an overwhelming amount of information. News channels operate 24 hours a day. Social media constantly generates new predictions. Everyone claims to know what will happen next. Darvis teaches us that too much information can sometimes be harmful. A simple, disciplined strategy often works better than endless speculation. Lessons for modern investors. Although this book was written decades ago, its lessons remain surprisingly relevant. Technology has changed, markets have evolved, but human psychology remains the same. Investors still chase hot tips. People still panic during market declines. Greed and fear still dominate decision-making. Darvis's principles continue to work because they are based on timeless human behavior. Whether you trade stocks, ETFs, or other financial assets, the core lessons remain valuable. Key takeaways from the book. Let's quickly summarize the most important lessons. Follow strong trends. Buy strength, not weakness. Use stop losses on every trade. Keep losses small. Let winners run. Ignore rumors and tips. Control emotions. Trust a proven system. Be patient. Focus on discipline rather than predictions. These principles help Nicholas Darvis turn a modest account into a fortune. Final verdict. So, is How I Made $2,000 in the Stock Market worth reading? Absolutely. This book is not just about making money. It is about developing discipline, controlling emotions, and creating a repeatable investing process. Nicholas Darvis proved that extraordinary success does not require insider information or complicated formulas. It requires patience, discipline, risk management, and the willingness to learn from mistakes. His story reminds us that success in the stock market is not about being right all the time. It is about managing risk, following trends, and staying consistent. And perhaps the most powerful lesson of all is this: cut your losses quickly and let your profits grow. Thank you for watching. If you enjoyed this book review, don't forget to like, share, and subscribe for more investing and personal finance book summaries. See you in the next video.